So this sounds like such a great idea, right? Can I refinance my mortgage without changing my interest rate? And I understand why many of you have this question. In fact, when someone first asked me this question, I didn't think much of it. I just went ahead, answered the question, found out what the needs were, and just gave them the options. But then 2, 3, 4 other people started asking me the same question, and it occurred to me that this may be a common question that viewers may want an answer to. So why not record this video? If you're new to my channel, I'm Johan Alvarez, a mortgage loan originator based out of North Carolina. And if you're coming back to watch my video, I really appreciate you tuning in. I look forward to receiving your comments, so don't forget to comment. If you have additional questions related to this topic or have other topics that you would like me to answer, please leave them down below. Don't forget to subscribe, like my video, and let's get right into it. So what is a refinance? Let's start with that. You already have a mortgage, you agreed with the bank on paying them back the loan that you got in a promissory note. If you remember that stack of papers that you signed with the lawyer when you were at the closing table, there was one important document in there called the promissory note. And that essentially was your promise to repay the loan. So you agreed to pay back X amount by X amount of time at X amount of interest rate and X amount on a monthly basis, which includes principal and interest most likely, right? You can only refinance by qualifying for a new loan to pay off this existing loan. With the current market right now, you've noticed that interest rates are a lot higher.
6% mortgage rates were accepted as the new normal. I think now we're in an environment where 7% mortgage rates are now the new normal, and people are accepting it.
Prices at the pumps, as well as growing mortgage costs tied to higher interest rates, drove inflation higher in July.
30-year fixed for conforming loans rose to 6.85% from 6.75%, and that's for loans with 20% down. While that was the average for the week, a separate survey from the Mortgage News Daily showed the rate crossed over 7% last Thursday.
You're trying to figure out how can you do this refinance without touching, without modifying that promissory note that you already signed and agreed with the bank, right? That is what you signed. You have to be aware that you cannot just amend that contract. Actually, there is one way to do it. And we're going to talk about this next, and it's called a loan modification. Many of you may not be aware, but I used to work in the loss mitigation department for one of the nation's largest banks. And at that time, we were going through the recession, foreclosures, and part of my job within the bank was to underwrite loan modification applications. And this is the only way that you can amend that contract that you have with the bank, the promissory note, especially if you have a hardship. So the only way that you can amend it is with a hardship. You have to reach out to your current bank. It's not something that you can apply to with a new bank. You have to go directly to your current loan servicer and ask them what your options are for a loan modification. In this loan modification, you may be able to amend the interest rate. You could have a principal reduction, or maybe they're gonna add some of the arrears back on the loan, but that's not something that we're seeing very common during this time because let's go back to the first question. You're trying to refinance because you probably have a lot of equity right now. You're probably trying to tap into that equity, and you're probably not having a hard time making the payments. You're probably not in foreclosure either, because if you were in imminent risk of being in default or going into foreclosure, you could easily sell this property with the amount of equity that you have right now and not have to go through that process, right? Let's talk about why are you trying to refinance. So you're most likely trying to refinance because maybe you've accumulated some credit card debt, maybe you purchased a vehicle, maybe your job situation has changed, your income has changed. Something has changed in your household where now you're trying to figure out, how can I tap into this hard-earned equity so that I can fix this problem that I have that could be temporary, and you're trying to solve it with a refinance. So to clarify, if you do a refinance, you have to qualify for a new loan, which means you have to get current terms that's available on the market. So if you're looking to do a cash out refinance, you can expect that interest rate to change. In reality, there is no way for you to refinance and keep the interest rate that you have. But if you're looking to get some of the equity that you have the option of doing a home equity line of credit. And a home equity line of credit is great. It's one of the benefits of being a homeowner, right? That's why a lot of us think of getting into home ownership. Aside from the comfort, the privacy, being in a community, you have appreciation of the home, and then you have amortization, which is you reducing the balance every month on the loan, right? So the combination of this creates this equity that many of you have noticed has increased, especially during COVID. And what you're trying to do is probably consolidate some debt. Maybe you've accumulated some credit card debt. Maybe you're trying to put some kids through college. You have some obligations that are coming up with this new school year that you'd like to facilitate for your children. Or maybe you had a plan to sell the home and maybe move up or move down, but that plan has changed because there's no inventory in our market. You're probably going to try to make your home work, right? So if you have an older home, you're probably trying to find a way to rehab this property and not get yourself into another credit card debt or maybe a short-term debt that you may be able to solve through a home equity line of credit. The good thing about the home equity line of credit is that you can obtain maybe a 20-year, a 30-year loan, which is going to make that payment as affordable as possible. The interest rates can vary depending on the bank where you apply, but they're not going to be as high as a credit card. So that's also a benefit of a home equity line of credit. And when I've asked the question of why are you considering refinance to the people that have called me, the common answer that I get is that they just want to have one single payment to make every month. And unfortunately, that's not something that you'll be able to accomplish when you qualify or apply for a home equity line of credit or maybe a second mortgage. If you're trying to just get a fixed rate and a fixed amount of time, you're going to have two payments. I mean, that's just the reality of it. There's no other way for you to do it. What you're going to have to consider if you're interested in going through this process is your monthly budget. It's very important that you understand how much money is coming in to your household, so that way you can decide if you can afford to tack on another mortgage on your home. Now, you may be able to accommodate your budget with paying off some of the debt with this equity, and you may realize that it's not feasible for you to add another mortgage onto your monthly obligations. If this is the case, then maybe a cash out refinance is the best option for you. If your employment situation has changed, if maybe your household income situation has changed, if maybe one person in the household lost their income, now you're just working with one income source, well, the temporary solution to that for your monthly budget is going to be a cash out refinance. The benefit of a cash out refinance is that you'll be able to tap into your equity. With extending the loan back to 30 years or 20 years or however long you want to extend it to, you're going to be able to accommodate having a lower monthly payment and one single payment to make. Qualifying for a home equity line of credit may not be as easy as it may seem. It's a second mortgage, which means that they're in second lien position to the home, right? So your current mortgage right now, if you're not refinancing it, they have priority over this home. So if you default, if something happens and you're not able to make the payment, the priority is going to be towards your current mortgage holder. The second lien that you're going to add on, they're in second priority, so they're going to be a little bit more picky about how they're going to qualify you or what the requirements are going to be. So they may ask you for a higher credit score. They may not lend 100% of the value of the home. They may only go up to 80%. They may only go up to 90%. It's going to depend on which bank you go to. But if you find yourself having a hard time qualifying for a home equity, a cash out refinance is going to be the best option for you. Can you refinance and keep the same rate? No. But if you're going through some type of hardship, if you find yourself in a difficult situation, reach out to your current lender. They'll be able to give you some options on maybe modifying your current mortgage, which could be something similar as to what you're asking. But if you're not having issues and what you're really looking to do is tap into the equity, remember, you have two options. You have the option number one, which is to obtain a home equity line of credit, or maybe just a second mortgage with a fixed rate. And you have the second option, which is going to be a cash out refinance. It's not going to stay at your current rate. You're going to have to refinance at the current market interest rates, but this can help you solve your temporary situation. And the good news is that there is no limit to how many times you can refinance. So although interest rates are up right now, at some point in the future, they're going to come back down. We don't know when, we don't know at what level, but hopefully they do come back down. And when they do, you can refinance your mortgage, or if maybe this is not your forever home, you could sell it and get a better rate on your future home, or maybe this can become an investment home and you move into your forever home. All right, so if you know of someone that's been asking this same question, Please share this video with them. And if you have questions that you would like to review with me, I have left my contact information in the description below. Don't forget to like and subscribe. I really appreciate you watching this video. I hope that it was very informative. And don't forget to comment in the video if you would like me to talk about another topic. See you in the next one.